Good afternoon and good morning, everyone, depending on where you're joining us from. Welcome to the last day of our special 4-day webinar series, the Midway Mark, Reflection and the Road Ahead for 2025. I am Ryan from Horizon Insights, and I'm honored to be your moderator for today's session, proudly hosted by Horizon Insights and Mysteel Global. As we reach the halfway point of 2025, global markets continue to navigate a complex and rapidly evolving landscape. This year, we saw significant policy shifts, ongoing geopolitical tensions, and heightened market volatility. These challenges have also created opportunities for investors to rethink strategies and identify new areas for growth. Horizon Insights has been at the forefront of facilitating these conversations. We specialize in China-focused macro and commodity research, providing not only directional views on commodity prices, but also actionable trading strategies. By leveraging our extensive domestic industrial network and global reach, we help institutions make informed decisions and capture opportunities in dynamic markets. As the largest Chinese commodity market intelligence provider, Mysteel offers the first-hand database sourced directly from the market. Its Chinese database provides unparalleled coverage across every aspect of the commodity value chain, offering the most granular insights available. Mysteel is committed to international data governance standards, ensuring the reliability and accuracy. Notably, it is the first iOS CEO compliant Chinese PRA in this space, guaranteeing regulatory compliance and credibility. So, with the combined expertise of these two teams, we are here to help you navigate the complexity of the Chinese commodity market and make data-driven investment decisions. This 4-day event is designed to provide a comprehensive outlook for the year ahead. So today's theme is decoding the critical materials market. This session explores two of the most crucial materials for the energy transition, which is copper and lithium. From strategic buying opportunities to market pivots, our speakers will unpack key supply-demand trends and trading signals in the second half of the year. So we are excited to bring together a distinguished lineup of experts from Horizon Insights and Mysteel. We hope their perspectives will help you navigate the road ahead with greater confidence. Thank you for joining us. We are delighted to have you here and are confident you will find today's discussion valuable and thought-provoking. Before we begin, just a few quick housekeeping items. All attendees' microphones will remain muted during the presentations for consistency. Thank you for your contributions. We have received your questions before the webinar. We will try our best to address them today. And for those questions we aren't able to cover in today's session, we'll make sure to follow up with you after the event as well. In terms of today's agenda, the copper sharing will be 25 minutes, followed by a Q&A session. Then we will move into the lithium realm sharing, which is also 25 minutes, followed by a Q&A session as well. So we encourage you to type your questions into the Q&A box at any time, and we'll address selected questions during the Q&A session after each commodity sharing. If privacy is a concern, please feel free to rename yourself in the Zoom settings. Finally, just a quick disclaimer, the content presented during this event is for informational purposes only and does not constitute formal investment advice. Horizon Insights and Mysteel are not liable for any decisions made based on the information shared today. Please consult professional advisors for specific investment, legal, accounting, or tax matters. Without further ado, let's get started. To kick things off, please join me in welcoming Paula Xu from Mysteel. Paula is a highly...
Ryan,
Yeah.
Holly comes first. Holly comes first.
Okay, so let's first dive into the copper. Let's welcome copper analyst from Horizon Insights, Hongyu. So Hongyu specializes in analyzing the impact of macroeconomic and financial environments on non-ferrous commodities. She excels at uncovering the price dynamics reflected in data. By accurately grasping market trends, she deduces reasonable valuation and provides investors with professional strategic recommendations, including directional trades as well as relative value and arbitrage strategies with non-ferrous metals. Today, she will take us through the price outlook and trading opportunities of copper in the second half of the year. Hongyu, the floor is yours.
Okay, hello everyone. I'm Hongyu from Horizon Insights, and today I'm show the copper. The topic, our topic is by the dip in the second half of the year. At first, let's show the key point. We take the bullish on copper in the second half of the year, and our LME copper target is $11,000. And our key point, there are two key points. The first one is the copper market remains in deficits for the full year. This year we built our copper concentrates tracking system, and we use 17 major global copper producers as our samples, and the sample shows that the growth rates, the copper concentrate production growth rate is just 0.3% this year, and also the remaining copper concentrates we use profits as a leading indicator, and totally, and we revised full year copper mine supply growth to 0.6%, and for the demand we give a 0.6% slowdown from last year because of the tariff, and the copper market remains structurally tight through the whole year, and this provides strong support for the LME copper prices, and this is our first key point. The second one is the current net long positions held by funds remains low, and looking forward, we think the main trend line is will change from now the copper cathodes balance to the improvement of the economic expectations, and we think there are three factors. There are three strong factors. The first one is the strength of the U.S. economy, and the second one is One Big Beautiful Bill Act provides upward momentum for the economy, and the third one is the start of the rate cutting cycle. And here our key points. And at the beginning, we want to share something about our evaluation, and we can see this is our LME copper trend, and we divided copper prices as two main factors, two main parts. The first one is LME copper trend, and the second one is that use a price minus a trend. We can understand the trend as a moving average, and we think the copper trend is impacted mainly dependent on the two factors. The first one is copper market balance, and the second one is inflation. And we can see the trend. This is the trend. The red line, the blue line is LME copper trend, and the gray line is inflation expectation. And we can see there is a divergence from these two lines. We know that the inflation, behind the inflation, there are demand expectation and the cost expectation, but there is a miss of the copper supply, the issue of the copper supply, and we know what's a copper what's the most important and problem in the copper industry. We think it is the challenges from the declining copper ore grades, and there are two charts to summarize this problem. The first one, we can see the left charts. We can see this is the Sheffield copper trend, and the red line is copper mine capacity utilization. It is reversed, and this gray line is copper mine profit. And we can see this chart, the copper mine profit is going higher, but the copper mine capacity utilization is going down. And it shows that the declining of copper ore grades, and this is the left charts. And we see the right charts. It shows that the efficiency of the copper capital expenditure is going down. The blue line is Sheffield copper trend, and the red line is copper industry capital expenditures. And we can see the blue line leads the red line by 20 months and around 2 years. We can see, and that is it is good. It is easily to understand because we often see the copper prices go higher and then the copper capital expenditure go higher. And the gray line is copper mine production growth rate, and we can see the slope of the red line, the blue line, and the gray line has a divergence. And how we understand this, and we know that because of the ore grades is going down. And we see that the efficiency of the capital expenditures is going down. So when we go back to this copper trend, and we can see the valuation has some change. Because we can see where there's the divergence, we think if we see the markets, the copper market now, and we can see there is a little expectation change in the demand, and there is the copper price seems really sensitive to the demand changing, because from these two charts we can see we can see we should there is if we see if we stimulate the same production, and we need higher copper prices, and that's what we want to share about the copper valuation. And this year we give the copper mine output forecast is about 0.6% and 130 ktons. And this year we by the Kepler global copper mine export value, we think it is an important value because it has a daily copper mine export from all over the world. And from this chart we can see this year's copper concentrate has shows more pressure now from the beginning of the year. If we see the first quarter, the blue line, we can see the first quarter, the copper concentrate growth, copper concentrate export shows it is really normal. And in the second half year, it shows some pressure. And we can see in July, there is significant pressure in July's copper mine export. And this right chart shows that how we give the forecast about the 2025's copper production, and we can see before July we use a Kepler global copper mine exports to forecast the production, and and in the second half of the year we take the 3 steps. The first one we use 17 samples. These 17 samples include some big copper producers such as Freeport, BHP, and Codelco. And the guideline in 2025 shows that there is 0.3% growth rate in copper concentrate. And the whole 17 copper producers accounts for 55% of the total volume, and the rest 45% we estimate others by profits. And if we see the others, that means the total volume minus 17 samples, and this shows a small and mid-sized copper mine production, and the red line is copper mine profits. And we can see the red line leads blue line, the small and mid-sized copper mine production by 2 years, and that shows the small and mid-sized copper mine production producers are more sensitive to the copper price. And if we use this lead indicator, we can give the this sample, the small and mid-sized copper mine production, the growth rate is just about 2%. So back to this. And we can see totally, if we see the big and small and mid-sized copper production, this year the growth rate is about 1%. And also we consider something about the disruption In the beginning of this year, we gave the distraction around 5%, and now we revised up the distraction from 5% to 5.5%. So we give this year's 0.6% production output growth rate. And next, we see the demand. We think the trade war expected to drag global growth by 0.6%. And how we calculate this? We just calculate the U.S. import values share of global GDP and the U.S. export values, and also we consider the impact of rising costs on demand. And we add the three parts impact, and it shows that the total impact on global GDP growth is about 0.6%. So let's see our global copper balance, and we think the conclusion is that the balance remains in a deficit. And if we see this, this is total mine production growth rate is about 0.6%, and this is consumption growth rate is about 2.8%, and we can see in 2025 it is 3.4%. And if we see the balance, the total mine production minus the consumption, and we know that it is tight. It is a tight balance, and it's tighter than last year. So according to this balance sheet, and we give a strong support for the copper price, and so this is our strategy by the dip in the second half of the year. And next, we talk about something about the positions. The first one, we know that the copper price is a bet on global growth rate. If we see the left chart, the blue line is Sheffield copper trend, and the red line is real GDP growth rate, and the gray line is refined copper consumption growth. And we think the three lines shows there is a great correlation, and we see the right charts, and we know that the copper in LME market, the commercial participants just accounts for 30% to 40%, and the rest of the positions are investment positions, and we know it is net long positions of the LME copper investment funds, and this is 25 relative to 2024 G20 GDP expectations. And we know that these investment funds just adjust their positions according to the GDP expectations. And we know that the net long positions now is at a relatively low, and we can see the GDP expectation is also at a low place, and we think that if the net long positions will go up, it will the condition it is there is a necessary thing is that the GDP expectations will go up. And what's our opinion? We think, we think the GDP expectations will improve in the next second half of the year. And there are some reasons. The first one is if we see the U.S. economy now, and we think the economy performs very well and beyond our expectations. And last month, we can see the if we see the U.S. consumption and production, the data shows that U.S. economy performs very well, and this gives the expectation improving. It gives the condition of the expectation improving, and we see the second one is a physical expansion. And we think it is a key long-term driver for the copper price. At first, we see the right charts. It shows copper trend and some physical budget deficit as a percentage of GDP. The first one, we see this is copper trend, is blue line, and this U.S. deficit, and this Europe deficit, and this is China's deficit to GDP. And we know that the physical expansion and the physical expansion is a key, is a strong driver for the copper price. And we see this left picture, and this shows that deficits by under Senate's past One Big Beautiful Bill Act. And we can see in the formal law, the deficit this deficit next year is about 5.5%, and after the act implementation, we can see the deficit goes up to 7%. So we think it is a strong driver for the long term. And the second one is a monetary easing. We think the rate cutting opens upside potentials. This is LME copper trend, and we know this is interest rate cut expectation for September implied by CME. And we can see the probability is about 64%. And we know that the U.S. economy performs very well, but we know that if the U.S. economy performs very well, this red line, the probability of rate cuts in September may be lower. But we know it doesn't have a strong downside driver if there's no rate cuts in the September, because we think we're standing at the crossing road. It is a start of the monetary easing cycle. So we think monetary easing opens upside potential. Finally, we want to talk about the copper tariff, U.S. copper tariff, and what's our conclusion about the U.S. copper tariff impact? We think it is limited downside from U.S. copper tariff, because we know that it is when the U.S. copper tariff implementation, and there is some pressure for the copper cathodes balance in non-U.S. markets. But as we see in this picture, we consider more about the net long position of LME copper investment funds, and we think the non-commercial positions is a more important driver for the copper price to this global copper balance. And we know that the supply growth rates is about 0.6%, and the consumption rates is 2.8%, and we get tighter copper supply balance sheet this year. So we think we are really positive to the copper price in the second half of the year. Okay, that's my sharing. Thanks, Ryan.
Yeah. So thank you, Hongyu, for the clear directional views. I think it has definitely provided a better understanding of the rhythm for those who seek opportunities in the second half of the year with copper. Now, please join me in welcoming Paula from Mysteel. So Paula Xu is a highly accomplished research analyst and a manager with over 12 years of distinguished experience, specializing in global and China's non-ferrous metals market. Currently serving as the manager of the ferrous metals division at Mysteel. Paula brings deep expertise in analyzing key metals like copper, zinc, lead, and tin across the entire industry chain. So she will walk us through the current copper market more from the fundamental perspective and the outlook for the second half of the year. Paula, please take it away.
Thanks, Ryan. Hello, everyone. This is Paula from Mysteel Non-Ferrous Division, and it's my honor to be here to share some insights into copper markets. Driven by macro and fundamental forces, copper prices in the first half of 2025 across COMEX, LME, and SHFE trended range-bound with upside bears under COMEX lead, peaking on March 26 and hitting their year-to-date low on the April 9th, yet displayed widening intermarket spreads and diverging volatility. COMEX greater than LME and LME larger than SHFE. In July, non-US copper prices have retreated from the rally with the easing squeeze risk and the US announcement of 50% of 50% new copper tariff effective August 1st, but still fluctuate at high levels amid China's policy momentum and tariff implementation uncertainties. Looking ahead to the second half, copper prices are expected to maintain strong floor support, limiting significant downside risks and trade within a consolidated high range. In the third quarter, there is a potential downward pressure from heightened market uncertainties and a seasonal demand lull. The anticipated rebound in the fourth quarter is expected to be driven by China's consumption recovery and global synchronized policy tailwinds. As we can see, among various influencing factors, tariffs undoubtedly have become the focal point throughout 2025, driven by the expectations of Trump's tariff hikes. COMEX copper prices began leading global gains in early February 2025, resulting in a significant premium from COMEX copper and substantially widened spread against the LME copper price. On July the 8th, the US announced completion of its Section 262 investigation into copper, with plans to impose a new 50% tariff on all copper imports by August the 1st. The investigation conclusion arrived nearly 5 months earlier than anticipated, and the tariff rate far exceeded market expectations of 25%. COMEX copper prices subsequently spiked, with SHFE and LME copper futures declined divergently. COMEX premiums to LME expanded sharply again, currently remaining above $2,500 per ton levels. This spread stood at around 25 to 30%, partially pricing the anticipated 50% US import tariff, but not fully incorporating potential tariff costs due to policy uncertainties. Since the investigation began, the high premiums have incentivized non-US copper flows into America. China's refined copper imports and exports were significantly impacted. During the first half, with exports rising by 2% year on year, but imports declined by 8.4%. LME copper inventories fell to their lowest year-to-date level on June 13, marking a 67% decrease since February 26 this year when the investigation was initiated. In contrast, COMEX copper inventories surged by 120% on the same day, exceeding the combined inventories of SHFE and LME. US imports of refined copper in the first half are expected to reach around 0.9 million tons, nearly equivalent to annual pre-tariff volumes. High inventories and front-loaded imports imply the US domestic oversupply. Post-tariff, non-US copper inflows will plummet, forcing the US to digest the existing stockpiles. China and Europe may absorb redirected copper flows. Meanwhile, China's refined copper exports will decrease, while tariffs aims to restore US copper smelting and processing. Rebuilding capacity requires time. Near to medium-term import dependence persists. The COMEX premium will likely stabilize at elevated levels, but reduce the volatility post-tariff as US supply-demand rebalances. The scope of applicable products and potential country-specific exemptions remains undefined. Whether the US copper's major suppliers such as Chile, Peru, Canada, gain exemptions will reshape global trade flows and impact COMEX premiums. Non-exempt producers may reload refined copper and copper semis production and exports of exempt countries. The tariff announcement has accelerated global consumption front-loading. With post-implementation, U.S. copper price inflation elevates manufacturing input costs, pressuring industrial copper demand. This demand destruction compounds with transmission of metals inflation to consumer goods, complicating the Federal Reserve's path toward monetary easing and raising risks of delayed cuts or renewed hikes. Overall, the tariff accelerates copper's transition from commodity to geopolitical instrument with lasting implications for global supply chains, inflation dynamics, and green industrialization. China remains heavily dependent on imported copper concentrate amid limited global mine supply growth. Although China's copper concentrate imports rose by 6% year on year in the first half, following April's open import arbitrage window, the subsequent closure of this window is expected to reduce imports in coming months. The 4-year imports are projected to show marginal year-on-year growth. Record low TCRCs starkly reflect current and anticipated concentrate tightness. Extreme TC compression has eroded smelter profits to break-even or loss-making levels. Operations are sustained only through long-term contract premiums and high-value byproducts. With no smelter large-scale production reduction or shutdown announced for the second half and constrained supply fundamentals, spot TCs are expected to remain at depressed levels through 2025. Copper scrap has become an increasingly vital supplementary raw material for China's copper smelting industry in 2025, accounting for a growing proportion of smelting feedstock. This surge has been instrumental in maintaining high domestic smelter output during the first half. The narrow refined scrap price spreads and seasonal recycling laws constrain short-term supply. However, supply in the second half is projected to follow a tight early, easy later pattern due to the trade policy drive end-of-life cycles, high copper price expectations, and improved margins for recycled smelting anodes with an overall growth expansion. The US was China's largest copper scrap source, accounting for around 20% in 2024. Affected by tariff policies, imports from the US plunged by 42% year on year in the first half of 2025. However, the total imports were marginally down by 0.38%, a shortfall offset by increased shipments from other countries like Thailand, Japan, Spain, etc. Although scrap copper imports may experience periodic dips in the second half, more frequent arbitrage window opportunities combined with steadily growing shipments from Europe, the Middle East, and Southeast Asia are likely to drive import recovery. Against the backdrop of steady domestic demand fundamentals, 4-year scrap imports are projected to match or slightly exceed 2024 levels. Consequently, China's copper scrap supply shows potential for expansion in the second half of 2025. Its contribution to refined copper output will continue growing, positioning scrap as a critical agent in the annual copper supply-demand balance. According to Mysteel data, China's refined copper output in the first half increased by 13% year on year, partly driven by improved capacity utilization rates in secondary smelting operations, despite scheduled maintenance peaks. In the second half, new production lines are steadily ramping up output. Production is projected to remain at high levels, potentially matching or marginally exceeding the first half volumes. Though constrained raw material supply persists risks of forced cutbacks. Benefiting from front-loaded exports and domestic stimulus policies, China's refined copper apparent consumption showed robust performance in the first half. Mysteel's survey showed that China's copper semis output in the first half grew by 5.7% year-on-year. Refined copper rod, copper tube, and copper foil contributed significantly to this growth, while production of secondary copper rod and copper bar performed poorly due to the squeeze on copper scrap supply by smelters and weak demand. In the second half, a refined copper rod will remain the primary driver of incremental copper semis output, and refined copper consumption. Apparent consumption of refined copper is expected to increase, with the full-year growth rate projected to remain at 7.3%. From the perspective of end-use industries, the main driver remains the accelerated growth in power grid investment, including potential demand from the Yalongjiang hydropower project. Growth in home appliances and new energy sectors has slowed, but still contributed some incremental demand, while Inisghts remains a drag on copper consumption. It is expected to improve from 2024 levels under series of policy incentives. From the perspective of inventories, despite sustained high China's domestic smelter output, robust seasonal peak demand in the first half, coupled with reduced imports and increased exports, resulted in tight social inventories. However, weakening consumption and anticipated growth in imports are expected to drive a continuous build-up in China's refined copper social inventories, with accelerated accumulation likely in the third quarter. Previously, increased smelter exports pushed China's bonded inventories. Subsequent customers' clearance for overseas shipments reduced stockpiles, while diminished import values further capped inventory build-ups. Going forward, the rising imports alongside reduced smelter exports should limit significant bonded inventory growth. Combined global inventories currently sit at normal levels. Recent reductions stem primarily from Chinese domestic drawdowns, while inventory transfers between LME and COMEX warehouses have minimized net decreases overseas. LME inventories are projected to rise following the hold in arbitrage-driven shipments. Meanwhile, COMEX inventories should peak and begin declining as in-transit cargoes destined for U.S. warehouses diminish. In conclusion, China's smelting capacity growth in 2025 exceeds market expectations, shifting the critical constraint from ore shortages to recycled copper availability. Incremental refined copper production will be dominated by recycled copper markets, with smelters' procurement capabilities for recycled materials determining potential output cuts. Benefiting from 2024's low baseline, 2025 consumption shows significant year-on-year growth potential with elevated growth rates. As the final year of the 14th five-year plan, consumption expectations remain optimistic with stronger momentum in the second half. Despite July's seasonal slowdown, the second half faces peak smelter maintenance, while consumption typically strengthens. This may reverse the current near-term strength forward weakness pattern, with July to October backwardation likely transitioning to contango. Anticipated tariff-driven trade flow adjustments could boost the fourth quarter's imports. For the Chinese market, macro-driven price collapse and summer power constraints are two key risks we should pay attention to in the second half of this year. If you would like to monitor copper dynamic markets regularly, please follow up on our data-driven weekly and monthly reports that provide comprehensive coverage of China's copper market, featuring insightful analysis in these articles and the latest key indicators, market trends, and on-the-ground market insights. Of course, Mysteel firsthand proprietary data assets, which all cover the whole industry chain behind the report, are available as well, including but not limited to price index, production, inventory, transaction, cost, consumption, etc. Please do not hesitate to contact us if you are interested in knowing more about our products and services. Free trials are available. Thanks for your time. Hope you are enjoying this event.
Yeah, thank you, Paula, for that comprehensive analysis into copper outlook. I'm sure all of us have a more of a refined expectation for the near future. So before moving into lithium, we would like to open the floor to your questions regarding copper briefly. So please submit any questions you have in the Q&A box, and we will do our best to address as many as possible in the time we have. So let's see if we got any questions. Okay, here's a question for Horizon Insights, Holly. So what do you expect for the copper market and price if there's no rate cut in September?
Yeah.
Holly?
We think. Hello, can you hear me?
Yep. Yes.
Okay. We think the precondition for the Fed to hold rates steady in September is strong U.S. Economic performance. So we think if that happens, the main trading line for copper will shift from strong expectations to strong fundamentals. Because as I was sharing before, we can see the copper concentrate production has really pressure. So we think the main trading line will have a shift. Yeah, that's the answer.
Great. Thank you. We see another question here for Paula from Mysteel. Is anti-evolution policy going to be sufficient to support ferrous, non-ferrous, and battery materials?
Oh, thanks, Ray. Actually, this kind of hot topics recently in China. While anti-evolution and its corresponding steady growth policies may have varied impacts on prices across different industries and commodities, the core logic remains products currently at low price levels may experience short-term price support and sentiment-driven upward movement or high range fluctuations. However, long-term sustainability dependent on like how effectively price changes transmit through the entire supply chain. The second, like the fundamental evolution of overall supply and demand. The third, the progress and details of policy announcement and concrete implementation regarding price, supply, and demand extra. The fourth, changes in the international environment, like for example, copper prices are already at high levels with short-term fluctuations heavily influenced by macro factors like anti-innovation and steady growth might provide some sentiment price support, but the effect is likely limited. Sustained price impact hinges on how specific policies targeting the entire copper industry, like power grids, PV, new energy vehicles, AI extra, translate into tangible supply and demand shifts after implementation. However, with the tightening supply, increasing demand, and inflation, it seems to be a generally acknowledged trend that copper prices are trending upward. Another example, like PV industry, driven by anti-involution, prices for previously low-cost silicon materials have risen, putting up prices for cells and PV models. Policy support and its cost sentiment may temporarily maintain prices in high ranges. However, underlying oversupply, sluggish demand, and low electricity prices cap the upside potential and sustainability. Prices must inevitably return to fundamentals, like with declining power plant profitability, the deepening construction enthusiasm, and evolution-driven price hikes are unsustainable. The industry risks falling into a cycle of like high price stagnation to inventory build up to price correction. That is my opinion. Thanks.
Great. That was very well rounded. I'm sure that pretty much would answer his or her questions. So for the matter of time, we'll just keep going for now. And for those questions that have yet to be addressed, don't worry. We will make sure to follow up with you after the event as well. So let's shift our focus to lithium. We are excited to welcome Senior Editor at Mysteel, Aggie Hu. So Aggie is a renowned expert in the lithium-ion battery market. With years of hands-on experience tracking China's lithium sector, Aggie brings unparalleled insights into market dynamics, from price trends and inventory fluctuations to capacity utilizations and involving policy impacts as well. So now she will share the reflection on what has unfolded this year so far for China's lithium market and more on the supply demand trends for the remainder of the year as well. Aggie, I'll leave it to you now.
Thanks, Ryan, and thank you for the opportunity to share with you my still insights on the lithium market. First, let's have a quick review of China's lithium carbonate prices, and we will go back a little bit further to the beginning of 2024. In the first half of 2024, the lithium carbonate prices were resilient with support from both the supply and demand. On the supply side, the environmental checks in Yichun City raised concerns about potential supply shortages, and the demand end was also strong with support from both the EV battery and energy storage battery sectors. And high prices also encouraged the lithium refineries to open hedging positions extensively. And in the second half of 2024, the lithium refineries actively produced the lithium carbonate and then sold them on the futures market as they opened hedging positions when the prices were high in the first half. Both the warrants and traders' inventory continued to increase, and such inventory accumulation led to persistent price cuts. Then, from November 2024 to February 2025, the lithium carbonate prices initiated a small rally. Again, the supply concern played a part as CATL suspended its production lines in Yichun City for overhaul. And the performance on the demand end was better than expected. In this case, both the traders' inventory and warrants' inventory started to fall, which offered some support to the prices. Then, from February 2025 to June, the lithium carbonate prices were back up to the down cycle. In this period, the lithium carbonate profits were in the negative based on the prevailing lithium ore prices. The tollers, on the other hand, had to lower their offers of fabrication charges in order to secure the orders. And the fabrication charges offers were close to their cost, actually. In this case, the lithium players had poor interest in buying lithium ore and processing them into lithium carbonate. Therefore, during this period, the lithium carbonate inventory accumulation was slower compared with that in previous years, while the lithium ore inventory accumulation continued. Now let's look at the lithium market transaction methods. Typically, the proportion of long-term contract against the spot transaction shows how many lithium carbonate can be freely traded. Higher proportion of long-term contract means fewer lithium carbonate available on the spot market. From the figure on the left, we can see that the price increase of lithium carbonate usually comes by a lower proportion of long-term contracts. And since the lithium carbonate futures contract was launched on Guangzhou Futures Exchange, the share of spot supply has increased from around 10% to 30% at present, indicating a more active spot market. And importantly, about 90% of sports market quotations now use futures-based premiums and discounts. This also means that the capital moves are having an increasingly important impact on the overall pricing. On the contrary, the long-term contracts primarily refer to third-party price reporting agencies, prices like Mysteel, with very few of the long-term contracts using futures price. And starting from this slide, we will see some important supply and demand data in the first half of 2025. First, in 2024, the lithium ore inventory decreased while the inventory of lithium carbonate accumulated, as I explained earlier. But the inventory showed opposite trends entering 2025. That is, the lithium carbonate inventory accumulation pace has been rather slow this year, primarily because the lithium carbonate profits were in the negative, and not many would aggressively ramp up the lithium carbonate production if they are not making money. In this case, the lithium ore inventory was on the rise. If you can see from the images here. Now let's move on to the lithium carbonate production situation. In the first half of 2025, China's lithium carbonate production continued to increase, and the monthly production once touched 80,000 tons. And the combined production in the first half of this year showed a 38% year-on-year increase. By raw material, the lithium carbonate produced with spodumene still posted increase, with the commissioning of some new capacity and some production lines shifting from hydroxide to carbonate. The lithium carbonate produced with the lepidolite also experienced increase after 3 CATL invested refineries came back online. However, the lepidolite-based refineries with a capacity of 10,000 to 20,000 tons per year reported very low capacity utilization rates. By region, Jiangxi still remained the largest producing area with a share of 38.5% in terms of production in the first part of 2025. And the share of Sichuan and Qinghai stood at 19% and 15% respectively, with Qinghai reporting an annual fall. And from the perspective of lithium carbonate consumption, the growth rate on the demand end was slower than the growth on the supply side. And this is an important cause why the lithium carbonate and lithium ore prices dropped continuously this year. Here is a summary of the supply side dynamics in the first part of 2025. The valid lithium carbonate capacity has reached 1.76 million tons per year, among which 1.4 million tons use spodumene and lepidolite as feedstock. The capacity utilization rates averaged around 48 to 50%, but among them, the brine lakes and refineries with captive mines or long-term feedstock others reported relatively better capacity utilization rates. The refineries relying on outsourced lithium ore suffered losses in entering 2025, and some of them survived by opening hedging positions. And such situation is projected to reappear from time to time in the future, especially when the lithium carbonate futures price rebounds. And in the first half of 2025, the tollers constantly lowered the offers of fabrication charges, which were even close to their cost level as a result of negative profits of lithium carbonate based on the outsourced lithium ore prices. But it is expected that such situation will accelerate the phase out of some high cost capacities. And therefore, lithium refineries are advised to prepare for a prolonged down cycle, probably ranging 2025 until 2027, accompanied by the phase out of refineries with insufficient competitiveness. And the key to survival is, of course, healthy cash flow and low cost feedstock. But despite the constantly falling spodumene prices, which fell below $650 per ton once in the first half of 2025, the major miners still maintained normal production. But the lithium ore inventory accumulation has been observed across the world, and the lithium price is expected to encounter a substantial pivot after key miners decide to reduce the production substantially. And this slide offers a summary of the demand situation. The global growth rate of electric vehicles in 2025 is estimated at around 20%, and the estimated growth rate of the energy storage sector is at around 30%. If so, the global lithium demand in 2025 will likely add up to 1.32 million tons of LCE. Now let's move on to the outlook for the China's lithium market in the second half of this year. In 2025, the recycling sector is expected to contribute around 80,000 to 100,000 tons of lithium carbonate production. If the lithium carbonate demand reaches 1.3 or 1.35 million tons LCE in 2025, the demand for primary resources will be around 1.2 to 1.25 million tons LCE, with a corresponding price range of 60,000 to 64,000 yuan per ton. Should the monthly average lithium carbonate spot price fell below 60,000 yuan per ton and remain at this level for a certain period of time, we expect that the lithium carbonate will see the destocking of both lithium ore and lithium carbonate. And on the demand side, we see some concerns looming ahead. And first, let's look at the EVs market. Generally, good wholesale data does not necessarily mean good actual demand, because many cars have become 0-kilometer second-hand cars. It means that some EVs are sold as second-hand, but they are actually brand new, and such practice may overdraw the consumption of EVs in the near future. but this can hardly be avoided as the distributors are under heavy pressure. But the demand still exists. We can see that the newly launched EV model of Xiaomi received more than 260,000 vehicle orders, and the battery orders for Xiaomi cars are mainly supplied by CATL and BYD. And there is also concern over the high battery inventory. We can see that the battery stocks are increasing on the whole, but looking at the inventory to sales ratio of battery factories, it indicates that the battery factories are in the process of destocking because according to the new national standard for batteries, it is necessary to reduce the inventory of batteries that do not meet the standards as soon as possible this year. And this is our whole year lithium carbonate supply demand balance sheet and outlook. And the basic conclusion is that we still think the second half of 2025 will be trapped in an overall oversupply. But I will take this time to talk a little bit more about the volatile lithium carbonate prices recently. Actually, the lithium carbonate prices slightly rebounded around the end of June when the demand side showed resilience in the traditional off-season. In addition to the bullish sentiment on the macro front, but the prices started to surge when the supply concerns were deepened by the production cuts. To be more specific, on July the 17th, Zhangge Mining's subsidiary suspended the production as its lithium extraction activity faces compliance issues. And this incident underscores China's tightening compliance regulation over mining rights. And this has made the market players to worry about the potential supply disruptions in Qinghai and Sichuan, in Qinghai and Jiangxi, which are two key lithium producing regions. And in Qinghai, the issue is that the lithium extraction volume is potentially beyond the approved level. And in Jiangxi, some projects may have to renew their mining license as the existing license mostly approves the mining of ceramic clay rather than lithium. And it remains uncertain as how long it takes to renew these licenses. However, the lithium carbonate futures gave up a considerable part of recent gains in the first two trading days this week. This is partly because it seemed that there were no signs of actual production suspension apart from the already announced ones, and the large hedging positions opened by the market players in the previous few trading days started to weigh on the market. But the recent price moves still remains uncertain because there's still risk that the supply will experience certain disruptions. And based on the previous production scheduling in July, the existing production disruptions will likely reduce the July production by around 2,500 tons compared with our original expectation given at the beginning of July. And this is our estimations for lithium carbonate prices in the second half of 2025. And the basic logic is that the market will remain oversupplied, which will likely make the price rebound short-lived. So to sum up, continued oversupply through 2025 is likely to bring down the lithium carbonate price, with the cost forming the floor and the hedging demand forging the ceiling. we expect that the lithium carbonate spot prices will move between like 56,000 to 75,000 yuan per ton in the second half of 2025. So this is the end of my presentation today, and I will give back the floor to Ryan. Hi, Ryan.
Thank you, Aggie, for sharing your view. I think the breakdown of key supply demand was really helpful for us to gauge this market clearly on the more fundamental level. So lastly, please welcome lithium analyst from Horizon Insights, Junrui Chang. Junrui specializes in lithium battery industry analysis, examining global lithium supply demand dynamics in key supply chain segments. By assessing market drivers such as supply demand shifts, inventory cycles, and technology trends, he delivers strategic insights and trade opportunities for industry stakeholders, alongside policy and resource competition analysis as well. He will give us an update on the price forecast and potential trading opportunities from his end. Junrui, you may take the floor.
Yes, thanks, Rory. And for me, and I will introduce our opinion and trading plans about the China lithium market. So first one is that we say that the lithium price has increased a lot during the end of the June, and we think there have three main reasons we want to mention. The first one is that we already say that the supply and demand grows simultaneously in the July, and for the first one is about the supply. So we think maybe the supply will remain the current levels, and at least there maybe has no sustained drives for the production increase. So which means that the lithium carbonate operating rate in the China market will remain stable in the July and August. And for the consumption part, and we can say that the lithium consumption has already exceeded the market expectations because based on our calculate, the demand will increase 2 to 3% monthly, but usually and in the China market, the July is a traditional off-season month. So which means that at least the lithium demand is still great in the July. And then for the inventory part, and although we can say that the total lithium inventory still increase in the July, but we should focus on the stock of the industry chain. So which means that we only focus on the refineries and the downstream, such as the cathode materials companies. So for right now, the inventory backlogs just occur in the trading sectors, such as for the other trading order retailers, and they will have the lithium inventories increase. But you can say that for the refineries and the downstreams, and the total inventory is not changing a lot during the July. And this is the first reason. And for the second reason is that we think that there may be no intention to register the GFX warehouse. So the first one is that if we find out the lithium carbonate basis, and typically it's about minus 400 to minus 100 yuan right now. But if we're considering about the GFEX warrant register phase, so which means that the sellers doesn't have this kind of profit space to register the GFEX warehouse. So which means that the willingness to register the new GFEX warrants is very low, at least from now. And the second one is about the demand about the lithium carbonate has not weakened in the July. So which means maybe some lithium batteries companies will also purchasing this kind of lithium carbonate warrants from GFEX. So which means you can say that at the end of June, and the total warrants has decreased from 22,000 to about 10,000. And for the last one is about the LC warrants will be cancelled yearly at the end of March, July, and November. But for this time, and we can say that warrant has dropped sharply at the end of June. So which means that the earlier than the market expectations, because maybe usually this kind of warrants will decrease at the end of July. So I think maybe this is a second reason about the lithium price increase. So because there has no willing to register the new GFEX warrants, so which means that we need to pay attention to the market corners at least right now. because we can calculate this kind of ratios, the open interest over the warrants, and you can say that this kind of ratio has hit new high levels. But for the total GFEX warrants, was significantly lower than the historical averages. So which means that there may be some potentially will have or some concerns regarding to the potential risk about the market corners. And I think maybe this is a second upward drivers in the lithium market. And for the third one is about the government operations about the lithium resource minings. So as you can say that maybe from the Jiangxi and Qinghai, and at least the government will strengthen this kind of operation about the domestic lithium projects. And until now, that we have already know that only one lithium project in Qinghai has been suspended, and for the monthly supply will reducing about 1,500 tons LCEs. But I think maybe in the future, the market will also concern about maybe there are more projects such as in Jiangxi and in the Qinghai, so they have been shut down or suspended. And I think maybe this is about the third reason about lithium price driving part. And then for our trading plans, and I think the first one is about for the GFEX market, and I think maybe the lowest point about lithium price in this year is about RMB 55,000 yuan, and transfer to the US dollar is about 7,500. So, however, we can say that there has already the price increase happened at the end of June, and maybe the highest level is about 80,000 yuan. And because this kind of reason happened is about the oversupply situations has adjusted at the end of June. So we think maybe we still recommend to open new long positions when we find out the future contract price is below RMB is 70,000 yuan. Because as we can say that the price also has many this kind of adjustment in these weeks, and I think maybe the most of the reason is that the speculated cash maybe will ending this kind of long positions, and this is the reason that why we can say that for the GFEX market, the price is from the 80,000 yuan to the 70,000 yuan. And we estimate maybe the GFX settlement price in July and August is about RMB 65,000 to RMB 80,000 yuan. So which means that we can still have about 10,000 yuan space when we do this kind of long position in the 70,000 yuan. And then for the arbitrage part, we have two arbitrage part opportunities. The first one is about cross market, and the second one is about cross product. For the cross market, and we think maybe we can launch the SGX or the CMEs in the overseas market and the short the GFEX, because we can say that this kind of spread has already maybe in the highest level in the history. So which means that at least the overseas the settlement price is lower than the GFEX. So which means that to do this kind of charge may be suitable for the current lithium price. And then for the last one is about the cross product arbitrage. As we can say that the GFEX has not launched this kind of lithium hydroxide futures, but we can say that for the China market, the spread about the LC and LH is still large in the historical levels. So which means that we can also suggest to do this kind of long LH and short LC in the Chinese market, because for the other part, as you can say that in the overseas market, the LLC and the LH spread is relatively smaller than the Chinese market. So which means that this is about our arbitrage opportunities in the lithium market. And I think maybe this is about our analyze about current situations in the Chinese lithium market and our recommended plannings in the Chinese lithium market. And I think this is what I want to share with you this times.
Yeah, thank you, Jinwei, for the sharing. It was very compact but insightful. As we know, the lithium market has been quite volatile in the past couple of days. I believe your insights have grounded us with, confidence to navigate through the market noise. So now we would like to open up the floor to your questions regarding lithium. Please, same thing, remember to submit any questions you have in the Q&A box. We will do our best to address as many as possible in the time we have left. Yeah, let's move into the Q&A session. Let's see if we have any questions. This one's kind of interesting. So this one's for Junrui. How would be the lithium prices for 2025 and 2026 looking at the tariff wars?
Yeah, for the tariff wars, we have do some adjustment about the US lithium market. So as you can see that we also calculated the cost increase in the US market. So for the lithium batteries, and we think maybe the average cost increase is about 40%. And for the electric vehicles part, and the average cost increase about 10%. So which means that at least we can say that maybe the US electric vehicle import volume will decline in the second half about in 2025 and the whole years in 2026. So we think maybe but we need to mention that for the US market, we maybe forecast that the 2025 the lithium batteries demand about 2,110 gigawatt hours. So which means that it only account about 10% about the total lithium batteries consumption globals. So I think maybe there have some negative impact on the US market, but for the total market, this kind of lithium battery demand decrease is relatively small numbers. So maybe they will not change this kind of demand growth rate a lot in the 2025 and 2026. And we should also focus on the China market and the Europe market about their electric vehicle or the energy storage demand increase in these 2 years.
Got it. Thank you, Junrui. So for the matter of time, we will just take one more questions. So this question is for Aggie. It would be valuable to understand Mysteel's view on lepidolite and spodumene cash costs in China. Any insights on that, Aggie?
Oh, okay. Hi, Ryan. As for the cash cost of lithium carbonate produced with a lepidolite and spodumene, the actual numbers differs project by project, but I will share with you our understanding of the fabrication charges as a reference for the production cash cost. As for a lithium carbonate produced with spodumene, originally the fabrication charges we heard were 25,000 to 28,000 yuan per ton, and the lowest level we heard was in June when the quotations for fabrication charges were as low as 19,000 yuan per ton. But now the quotations have rebounded a little bit to around 20,000 yuan per ton because the demand improved a little bit with more players trying to process lithium or into lithium carbonate via tunnels. And for lithium carbonate produced with lepidolite, the fabrication charges offered by the tollers will definitely double that of spodumene, but it makes a huge difference for producers with captive mines. We heard that the lithium refineries with captive mines could still maintain the production when the lithium carbonate prices were as low as like 60,000 yuan per ton, thanks to the scaling effect and success for a cost reduction through technology upgrades. So this is how our understanding of the production cost of lithium carbonate produced with lepidolite and spodumene. Ryan?
Yep. Thank you. And I hope that answers our audience question clearly. Just one more question for you, if you don't mind, Aggie. So here's a question. How would you explain the decrease of warrants in May, June, and July?
Yeah, okay. So first, if you look at the warrants data disclosed by the Guangzhou Futures Exchange daily, we can see that the traders hold the majority of the warrants followed by the producers. So the moves of the traders will greatly influence the warrant situation. And in May, June, and July, the futures and the sports market was in the backwardation structure, which the traders did not, it is not favorable for the traders to deliver to the futures market, and this is why the warrants start to or have been reducing things made this year. All right.
Got it. Yep. Thank you. Appreciate it. Okay, all right, everyone. I think that concludes our 4-day webinar series, the midway mark, reflection, and the road ahead for 2025. Thank you to our speakers for their valuable insights, and thank you all for your support and participation. We hope you found these sessions valuable as you plan for the remainder of the year ahead. If you have further questions or feedback, always feel free to reach out to us. And have a great day, and we look forward to seeing you at future events. Bye.